Hey everyone, Kevin here. Okay, so some people were reading into my last video that had the word sold in the title, and they're like, oh my gosh, here's Mr. Fudster Kevin. Oh my gosh, here's Mr. Flip-Flop Trader Kevin who sells everything again. So what I thought in this video is I would do a portfolio update after having paid taxes, which was a big F and a big L, depending on how you look at it. Actually, it's probably both. But anyway, first, I wanted to mention a few things about sort of my thesis on the market, because I think some folks think that you may be embarrassed when I'm not, because I really am not. I mean, here, come with me. So, first of all, here are the negative catalysts that we have. The yield curve inverted for literally like 36 hours. Okay, big deal. Who cares? We've got rising 10-year. This is a problem, mostly in my opinion, for real estate. But real estate eventually will trickle to the consumer. See, the consumer might still be strong today, and this is the biggest problem. Okay, so whether you're a bear or a bull, this is a sincere problem. The consumer is not certain to be forever confident if home values fall. Now, 66% of individuals, maybe 64% of individuals are homeowners. So you've got that other like 35, 36%, but a lot of people are homeowners. Home values start falling, people start spending less money, it's a problem. I suspect, though, that people won't necessarily just overall spend less money. I think people will spend less money on their homes, which impacts Lowe's, Home Depot, and Enphase, and Solar, and companies like that, right? I actually personally think that in addition to supply chain issues, that could be potentially one of the issues. We're seeing slower solar deployments at Solar, but that might be a reach. That's to come. Stay tuned. And I mentioned as well in January that we're going to see a rotation to consumer staples and commodities, and that's what we've seen. Now, I'm personally not a big fan of investing in commodities because you know that I like being able to take the opportunity of buying the dip in my longs, and I don't actually like trading that much. I like buying more of my longs. So these are issues. Housing's an issue. The PPI, huge disaster. And we know the PPI, the CPI, we know these vastly understate the actual inflation we're seeing. I mean, you just consider CPI, for example. You've got the fact that we use owner's equivalent rents, which is literally like a survey of homeowners. Like, hey, how much do you think you could rent your property for? It's like the stupidest thing ever because it way lags. And first of all, we know rents have done this while home prices have done this. So it's like, duh, obviously we're going to have a huge CPI differential there. That's a massive lagging indicator. But then we also have this stay-at-home issue. Shopify, Etsy, Netflix. These are all stocks that I don't own. I've previously owned Etsy. I used to love Etsy. But as I've said, I've rotated out of consumer discretionaries because it's not the place to be right now. And I'm investing more in sort of the upper echelon of consumer discretionaries, which I consider Tesla, really. And eventually, I think it'll be a staple. But anyway, stay-at-home is obviously getting wrecked. I mean, we saw the Netflix numbers. We don't have to go through that again. And we know we have these really ugly catalysts. I mean, if you really add one over here, you have April 18th. Which was tax day. I mean, I paid $9.5 million of taxes. It's ridiculous. That saps purchasing power. I mean, if at the end of last year I bought a big property or bought a plane or something stupid, I could have paid no taxes and I would have had more money to invest in the market, right? But most people pay their taxes on the 18th. And so, unfortunately, that's what I did. But anyway, now we've got earnings. And unfortunately, we're led by bank earnings, which were good. We were led by Procter & Gamble, which was good, and Tesla, which was honestly unfathomably amazing. I cannot believe Tesla's not only growing at 50%, but it's projected now, thanks to Elon, although he has rosy projections, to potentially be growing at a 60% clip. And you have increasing margins in this sort of environment. Insane. But anyway, earnings are potentially an issue, and we're led by this miss on stay-at-home. But I think we're going to see more misses on stay-at-home. And this really creates questions. Like, honestly, Disney is probably one of those stocks. I don't think I can do an upside-down question mark. But anyway, is one of those stocks where it's like, well, I don't know. I mean, like, their parks are probably going to kill it, but Disney Plus could be a total loser, right? We have no idea. So big, potential, like, I don't know, over at Disney, right? Because of Netflix. But anyway, you've got the FOMC meeting on May 4th. You've got jobs data coming out on May 6th. You've got CPI data coming out on May 11th. And then what do you have in between here? Come on, folks. May 9th is V-Day, Victory Day. I mean, you got a SH9T show coming up of catalysts. It's terrible. I mean, like, come on. Earnings either come in acceptable and they meet expectations or they miss. It's a disaster. Like, beats don't exist in this market. So you've got a lot of reasons to be bearish, and I don't blame anybody for being a bear. I was a bear in January, back when I thought the Fed was going to rug pull us. I thought we were going to get a 1% to 2% rate hike. I thought they were going to force a recession. Why? Because we had a wage price spiral in January. That wage price spiral was actually revised away in February. We had war, which reiterated the belief that maybe we shouldn't push for a recession because maybe consumers will spend less, although ironically consumers have been spending more. And the Fed actually changed to a little bit of a game-changing dovish tone, which is shocking because they've become very aggressive as of December, right? Those minutes that we got January 5th, the worst minutes I've ever read. If you just type into YouTube, meet Kevin, worst Federal Reserve meeting minutes ever, you'll see it, January 5th. It's terrible. Which, speaking of dates, reminds me of the fact that today is still 420, and you can get the absolute best prices on my program, that on any of my programs on building wealth, that you will ever be able to get in the future. I promise you there will never be a day that you could get these programs cheaper. Today is 420. It's the last day that you can do that. Take advantage of that. We'll be changing the pricing in the morning. Pricing will be elevating up. So if you want to lock in the best pricing and see me and private course member live streams and get all of my updated content in the future, which just between you and me, when we launch this new project we're working on, we're also going to be launching some new lectures, especially in our property management, real estate, and stock sections. So stay tuned for those new lectures. All the upgrades are totally free for those programs, so check those out. Really good for building your wealth in the long term. Use that code down below. I think it's CyberKevin, and that's really because so impressed with Tesla. I still have my wristband on. This is like 2 weeks old here. I shower with it. I love it. Anyway, so this is all the bad over here. But look at some of the good that we have. First of all, people keep referring back to the 70s and 80s, and they forget that, wait a minute, we have something that's very different from the 70s and 80s, which is the late 70s, early 80s, Paul Volckering. And the difference is unanchored inflation expectations. Back in the late 70s, people thought that, oh my gosh, we left the gold standards, the gold standard. The dollar is going to zero. If the dollar goes to zero, well, shit. Why would I hold the dollar? This is terrible. This is stupid. This is worthless. Like, inflation is just going to keep going to the moon. We're going to be wheelbarrows of cash like the Weimar Republic in the 20s in Germany. Complete disaster. But no, what do we actually have today is we actually have anchored inflation expectations. University of Michigan, 1-year inflation expectations, completely flat. What do we have for the 5-year inflation expectations? Completely flat at 3%. I mean, this is incredible. We know that consumers actually think that in about 3 years, mortgage rates will be like 8.2%. Don't get me wrong, I'm bearish on real estate right now. But I will take that as an opportunity to go shopping for real estate. But I know how to shop for real estate. I know how to get deals below market value. So that's easy. That's a cakewalk. So core CPI fell. This is mostly because of the Manheim index, which is the used vehicle index. And then we've got rental, lodging, air travel. People are still spending money like crazy, which, I mean, I just booked a trip, many trips. I mean, I think we're going to go to Hawaii again. We're going to go to Italy. We're going to go to Germany. I can't go skiing anymore. I'd love to take the kids skiing, but it's too late in the season. But anyway, people are still spending money like crazy, and I'm not exempt from that. We still want to travel. Travel is fun, especially after this COVID nonsense. And I've been exercising more. So for those of you asking about the fitness challenge, I now have a challenge of running 4 to, this sounds crazy, but 8 miles a day. Like my shins are killing me. Shin splints, they suck. But it's great. Like, I love getting out there again. And I feel the same way about hanging out with folks, whether it's at restaurants or bars or drinking at home. I don't care. It's fun. But COVID is over. All right? I know, obviously, COVID still exists. We saw that in Shanghai. Tesla reopened, blah, 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 whatever. All the freaking comments. See, I got to hedge, like, every angle. Every time I say something, I have to try to forget about it. Who cares? Freaking losers in the comments sometimes. Most of you, though, are really nice. I really appreciate you. Like, I see the nice comments, and I'm like, man, the core audience, these are good people. I really like these people. Anyway, so what do we got over here? This is probably the biggest thing right here. So you might not believe this, but back in January, the president of the University of Michigan's Consumer Confidence Survey said that we have a wage price spiral. So much so that they went out of their way to say that, wait a minute, when wages are growing at a faster clip than inflation is growing, we're in a wage price spiral. This is bad. This is really bad. This was one of the main core theses that was the reason I made sort of the Titanic video. Like, oh my gosh, we're on the Titanic, right? It was terrible. Now, fortunately, that turned out to be a nothing burger, thank freaking God, and we were able to purchase lower, which is also freaking wonderful. But what are some of the other things we have? The 5-year break-even. The 5-year break-even rotating down is very, very huge. This is the market's inflation of, the market's expectations of inflation going down. Consumer inflation expectations going down. The 10-year mostly steepening, although we did go from about 0.38 to about 0.28 after Netflix, which wasn't great. We had some flattening, but generally we're on this trajectory of steepening. Let's keep that trajectory going, okay? We don't want to go back to inversion. I don't know, a lot of folks don't remember this, but and I'm going to give you a portfolio update as well, okay? Because I have a little bit of margin right now, but I'm going to give you some clarity about my margin. I'm going to give you a portfolio update. But consumer margin right now is down 14.5% from October, which is really good. We've had a manufacturing beat in March, but at the same time as we had a manufacturing beat in March, we actually have less freight and rail shipments, which is a little bit of a sign that consumers are spending a little less money on things and maybe spending more money on services, which is the rotation that you would expect. You would expect to see a pull towards the extreme of services over, like, certainly durables, which are like washing machines and cars and other junk, with the exception of course, Tesla, which sometimes people are like, oh, of course, the exception of Tesla, Kevin, and you invest in Tesla, you're just trying to pump it. Dude, I can't. I wish I could pump Tesla stock. I can't. Maybe Elon can, but I can't. All he has to do is say funding secured. Oh, but anyway, look, consumer discretion, they're going to get hit. But banks, Tesla, Procter & Gamble, the earnings that we've gotten here, with the exception of obviously the negative of Netflix, huge freaking beats across the board here. I mean, we're killing it with the consumer. So I'm very optimistic. Now, I promised you portfolio updates, so let me give you one here, okay? And keep in mind, use Cyber Kevin, the coupon code, join me. So when you ask questions to me in person, we can have a dialogue about what you think about what's going on in the market. Maybe, what do you think, like, what would Kevin do in your shoes to try to get ahead and get to the next level, whatever. Or, hey, here's my real estate deal that I'm in escrow on. Kevin, do you think this is a good deal? I'll give you my sincere feedback. Y'all know I'm no BS. I tell you what I'm thinking, and sometimes I get hate for that, and sometimes I get praise for that. I mean, it is what it is. Okay, so portfolio update, all right? Portfolio update is pretty simple right now. I did just get tagged with $9.5 million of taxes, which is a complete disaster. So tentatively, I'm $7 million in margin, but I have about 4.8 in cash, which is very, very nice. So that's a nice little offset there. But if I go 4.8 cash minus the 7 in margin, I'm sitting at about negative 2.4 cash right now, which means I'm actually in margin, which sucks. But I've got some real estate transactions closing, which is nice because those real estate transactions are going to clear out my margin. So the point of this is, I'm not trying to advocate that anybody get into margin. I think margin is a terrible idea. You should not be in margin in this market. Otherwise, in terms of stock position, so I'm going to be clearing out my margin with real estate, and then what I'm going to be doing is I'm going to be taking the extra cash and probably a large chunk of my stock portfolio. We're going to be moving this over into a new corporation, which is the metkevin.com/Series A opportunity. There's not much I can really say about it right now, but if you go to metkevin.com/Series A, throw your information in there, you'll be the first to know about it, actually right after course members, because course members are going to have the first opportunity to potentially invest with me. So that'll be a really cool thing. So check that out, metkevin.com/Series A. And then, of course, if you want to become a course member, metkevin.com/join and use the coupon code CyberKevin. But anyway, my portfolio is really kind of whittled down to very, very few positions. So anytime I make a transaction, whether it's in crypto or stocks, you get an alert if you join the courses. But Tesla, 16,000 shares. Google, 606. Disney, 10,000. AMC, I still hodl my AMC, 2520 shares. ADA, 1 million shares or coins, tokens of ADA, and 25,000 shares of Trade Desk. That's my entire portfolio. So my stock portfolio right now sits about 21.4 mil. My net worth left that's still captured in real estate is probably somewhere in the direction of about 8 mil. That's a lot of I have quite a few properties that are still paid off in cash that are like, do I want to refinance them or just sell them? And I'm selling them. And I'm not selling them because I think it's a good idea to sell. I think for most people it's not a good idea to sell. I'm selling them because I want to move into this new opportunity. So, plus or minus, depending on the day's fluctuations, depending on how things open tomorrow, I guess that puts my NW somewhere around 30, which is certainly less than where it was at the peak of the market in November. But I mean, anybody can compare. Like, compare Kathy Wood and her fund at peak to bottom, and it's like, oh God, that's even worse. That's bad. But fluctuations in the market happen. So, I mean, if you're having that problem, by the way, where if you, like, you're trying to compare yourself to peak, be careful of that because it's really toxic. Like, it'll eat away at you. One tip I could give you, write it down. Like, write down how you're feeling crappy about, like, I wish I did this. Write down, I wish I did X, but I didn't, and I'm an idiot. Take that little piece of paper, put it in a drawer, and write down even on how you're feeling about it. Like, I feel crappy about this or whatever. And now, because you've written it down, you actually never have to think about it again because you've written it down. But of course, you know you're never going to look at that piece of paper again. So psychologically, now you can get it. So a little trick. Hopefully that helps you. If you want more tricks like that, I'm serious. I guarantee you. Otherwise, email me and be like, Kevin, I didn't learn anything. But I guarantee you, you will learn something in the programs. Any of them. I would personally, at this point in the market, recommend 0 to millionaire real estate investing. A lot of people bundle 0 to millionaire real estate investing with that Cyber Kevin coupon code expiring today. A lot of people bundle that with the stocks and psychology of money. And then usually what I recommend is, like, don't go all in right now and get the property management course yet. Wait a couple months, get through the real estate investing course, then get the property management course. The property management course is going to get some really sick updates within the next 3 to 6 months because our entire real estate plan is going in that course, which is going to be really cool. But you've got to go through 0 to millionaire first to really understand that, unless of course you're already exposed to real estate. Of course, there's a entire program, of course, on building a YouTube channel as well, or real estate sales company. So check those out. Link down below. Thanks so much for watching. Look, I'm bullish on the market. So to all the effing bears, I'm sorry. I'm not on your team. Michael Burry, go F yourself. And thanks so much for watching. We'll see you in the next one. Goodbye, folks. Bye.